Hey there, and welcome back to the channel. If you're new to investing, or maybe just looking to sharpen your understanding, you're in the right place. In the next few minutes, I'm going to break down the essentials, from what investing really is, to how you can start building wealth, even if you're on a tight budget. So, sit tight, grab a notebook if you want, and let's dive in. So, first things first, what is investing? Investing is simply putting your money to work so it grows over time. You're essentially buying assets, like stocks, real estate, or even your friend's startup, that you believe will increase in value. And this is different from just saving. With saving, you're stashing money away. With investing, you're taking calculated risks to grow it, sometimes by a lot. And here's the kicker: investing is not just for the ultra-wealthy. You don't need a fat bank account to start. Even small amounts can add up over time thanks to the power of compounding. Now, let's talk about risk, because this is a huge part of investing. Every investment has a certain level of risk and reward. The rule of thumb here is, the higher the potential return, the higher the risk. Stocks, for example, have higher potential returns, but they can be volatile. Bonds, on the other hand, tend to be safer, but the returns are lower. But here's the key: diversification. This is just a fancy word for not putting all your eggs in one basket. You want to spread your investments across different types of assets, like stocks, bonds, and maybe even real estate, so you're not overly dependent on one. If one investment dips, the others can help balance things out. It's the ultimate way to minimize risk without sacrificing too much on the rewards. Alright, let's talk about one of the biggest secrets to wealth building: compounding. This is when you earn returns on not just your initial investment, but also on the returns the investment has already generated. Think of it like a snowball rolling downhill. It picks up more and more snow as it rolls. That's how compounding works for your money. Now, here's the magic formula. The earlier you start, the more time compounding has to work its magic. Even if you start with small amounts, they can turn into serious wealth over time. So, the takeaway here? Start as early as possible. The sooner you begin, the more potential for your money to grow. Okay, so you're ready to start investing. But where? Let's start with stocks, ETFs, and index funds. Stocks. When you buy a stock, you're buying a tiny piece of a company. If that company grows and makes more money, your stock's value goes up, and you can make a profit. It's exciting, but remember, stocks can be volatile, so you have to be ready for some ups and downs. ETFs and index funds. If individual stocks seem intimidating, ETFs, exchange-traded funds, and index funds can be awesome beginner-friendly options. They're like baskets that hold many stocks, so when you invest in them, you're essentially buying a small piece of a lot of different companies. This can reduce risk, and you won't have to worry about picking the next big thing. These funds just follow the market, so when the market goes up, they go up. Now, let's address the big question: how much should you invest? Honestly, there's no one-size-fits-all answer here. But here's a good starting point. A lot of people aim to put around 15–20% of their income toward investing. If that seems high, don't stress. Start small if you need to. Even $20 or $50 a month is better than nothing. The key is consistency. Finally, let's look at long-term versus short-term investing, because this decision can really shape your strategy. Long-term investing is all about putting money in and letting it grow over years or even decades. This is where retirement accounts like IRAs and 401ks come into play. They're ideal for long-term growth since they come with tax benefits, and you'll have time to ride out market ups and downs. Short-term investing, on the other hand, is about quick wins, investments you might hold for a few months or a few years. Examples here include certain stocks, high-yield savings accounts, or even some real estate flips. But remember, short-term gains are usually less stable, so you need to be cautious. Alright, that's a wrap on Investing 101. To recap, we covered what investing is, why it's different from saving, and how understanding risk and diversification can protect your hard-earned money. We touched on the magic of compounding, where to start with stocks, ETFs, and index funds, and finally, the importance of knowing your timeline. Here's my challenge for you: take that first step. Whether it's learning more, opening a brokerage account, or just setting aside a bit of your budget to start investing, every action you take gets you closer to financial independence. If you found this helpful, give it a thumbs up, hit that subscribe button for more content like this, and drop a comment if you have questions. Until next time, happy investing.